On December 10th, the Federal Reserve cut the Fed funds rate by 25 basis points, bringing the target down to a range of between 3.5 to 3.75%. Now, this marks the third consecutive recent rate cut in an easing cycle that began back in September of 2024. Now, going into the meeting, the CME FedWatch tool had priced in a 90% probability for this move, so the cut itself was not a surprise. The significant development was the chairman's post-meeting statement regarding expectations for future cuts, and perhaps most importantly, the Fed's plan for their balance sheet. Now, equity markets usually respond well to any suggestion that the Fed will slow quantitative tightening, QT, or resume quantitative easing, QE. However, markets react negatively to suggestions that the easing cycle might pause. Now, that exact scenario led to a sharp 6% correction in the S&P 500 following the October 29th meeting. In this meeting, the Fed convinced the markets that the easing cycle wasn't necessarily near its end and that they would resume bond purchases on December 12th. This led to equity strength to the tune of about a 0.5% move higher. Now, it's also important to remember that for the last 2 months, we've seen less economic data due to the government shutdown. Now, those ramifications still linger. Even now, many traders are unsure which important data points are set to be released and when. Now, this may make any information that we do get more important. Now, today we're going to be using ES S&P E-mini options to represent our directional bias. If a trader believes that the S&P will rally over the coming days, they could buy a week 3 Friday, that's December 19th Friday, E-mini S&P 6930, 6940 call spread for 5.5 ticks, with the underlying March S&P ESH6 trading at 6925. This trade expires Friday, December 19th. The $275 we paid with 5.5 ticks, that's 5.5 times $50 a tick, and it will profit if the market rallies above that 69.40 level by expiration. Now, the gain would be the total tick value of the spread, 10 ticks, minus the 5.5 ticks we paid. So the total gain would be 4.5 ticks, or $225. Now, the benefit of a call spread is that you cannot lose more money than the amount you paid. Now, if a trader believes that the market will move lower in coming days, they could express that by buying the week 3 Friday 68.80, 68.70 put spread with the underlying futures at 69.25. This spread cost 3 ticks, or $150. Now, the profit potential is if the market is below 68.70 at December 19th expiration, and that'd be worth 10 ticks. So we would make 10 ticks minus the 3 ticks we paid, or $350.